So it's hard to start with a smile when this is what you're seeing on the headlines. Yes, we've had a really rough last 4 to 6 weeks of a lot of downside market volatility. But let's keep things in perspective. Year to date as a whole, the markets are basically flat, meaning a zero rate of return for the year. Look at these markets. So if you go back to 2010, we had handsome returns. The S&P 500 or U.S. large is up 15, emerging markets is up about 18, U.S. small value, I should say, is up about 25. Very strong returns here in 2010. The question is, was it easy or was it an easy ride to capture these market rates of return? And what can we learn from 2010? Well, if you remember, we had a strong upside for the first 4.5 months through about the mid-April timeframe. And then we had a 16% sell-off last year from April 23rd to July 2nd. That's twice the sell-off then that we're faced so far here today. Then, once the market hit bottom in July 2nd of 2010, it rebounded for a 23% return during the remainder of the year. That's how we got to the total of 15% for the S&P 500. If you had gotten out of the market due to fear at the bottom, you missed a 23% upside. On a $1 million portfolio, that's $230,000 of capital at work that you forfeited or would not have under your control. Now think back during that time frame of May, June of last year. Why the big sell-off of that 16%? What was present in the marketplace? There was fear. Fear of what? The Greek debt crisis, rise in debt here in the United States, high unemployment, worry about the economy, a double dip recession, worry about corporate profits. Well, let's compare that to what we're facing now. Once again, we had the fear of the Greek debt crisis. If you're looking at the U.S. debt, what's really interesting is, believe it or not, the yield on the 10-year Treasury today is lower than the yield it was last year, 2010, when we had this sell-off. What does that mean? If yields are low, that means people are buying a lot of bonds. If there's a real fear about our government debt, would they be buying those bonds? Unemployment is actually lower today than it was last year. And most importantly, corporate profits are the highest they've ever been. Very strong profits coming from companies. Their earnings are strong. So what changes and what stays the same? Well, what changes is the weather, the fear that's present in the marketplace, conditions in the market, economics changes to some degree, politics changes, the speculators and the prognosticators are always changing. But what's really important, what matters with your investing, is what doesn't change. Climate doesn't change. Fundamental principles of investing don't change. There's always going to be market volatility, but if you take that volatility, it's going to be market rates of return. The fact that investors are human and there's emotions that we can't predict, that's always going to be present. Use this to your advantage. What do we mean by that? What wins? Sound investing philosophy and sound investing strategy, and then secondly, having the practices in place to capture market returns and not lose heart. The first part of this is knowledge, and the second part of this is behavior based, really, in sticking with your practices that you know win. What are the consequences? We say win. Well, winning in this game is life or death. We always say this: your survival is on the line, because your ability to have enough money, not only now during your career, but throughout 30 years of retirement, does mean your survival. You have to have that capital at work to give you the income that you need to pay for the things you need to care for: your health care, your clothing, your home, your transportation, you name it. As I always say, invest wisely. Your survival is on the line.